Gold is crashing. At the exact moment the world is becoming more dangerous. Wars are expanding, oil prices are rising, inflation refuses to disappear, and yet, instead of running toward safety, investors are watching gold fall. That makes no sense, because historically, when fear rises, gold rises. So why is smart money suddenly stepping back? Is this just a temporary sell-off? Or is something much larger happening behind the scenes that ordinary investors still cannot see? Because while financial headlines tell people the gold rally is over, because while financial headlines tell people the gold rally is over, because while financial headlines tell people the gold rally is over, some institutions may already be preparing for something far more serious, a shift that could affect savings, retirement, businesses, and the global economy itself. And before this video ends, one question may completely change how they see this gold crash forever. Welcome back to John by Currency, the place where serious people come to understand the economic signals shaping the future before they become headlines. And for those wise viewers joining us today, especially those who have seen many market cycles in life, kindly consider subscribing to the channel. It helps this community continue growing, and together they stay one step ahead of uncertainty. Also, they would love to know, where in the world are viewers watching from today? Something unusual is happening in the global financial system, and many serious investors are struggling to understand it. Around the world, tensions are rising, military conflicts are expanding, energy markets are becoming unstable, inflation pressures are refusing to disappear. Normally, these are the exact conditions that push gold higher. For decades, gold has been seen as protection during uncertain times. When fear enters financial markets, investors usually move toward assets they believe can preserve value. Gold has historically stood near the top of that list. Yet this time, something feels different. Instead of rising with fear, gold has been falling. For many people watching financial markets, this creates a serious contradiction. Why would gold weaken at the exact moment the world appears to be growing more unstable? That question deserves closer attention because the answer may reveal much more than a simple market correction. Many headlines are already offering simple explanations. Some financial commentators say rising interest rates are hurting gold. Others argue that a stronger US dollar is creating pressure. A few believe investors are simply taking profits after a strong rally. But serious decision makers often understand something important about markets. When many explanations appear too simple, the real story is usually more complicated. Markets rarely move based on one factor alone. Behind every major price movement, there are often several powerful forces working together at the same time. This is where the situation becomes more important for business owners, investors, and entrepreneurs. Gold does not move in isolation. It reacts to inflation expectations, central bank decisions, bond markets, energy prices, and geopolitical risk all at once. Right now, many of these forces are pulling in different directions. Rising oil prices are creating inflation fears. Government debt remains elevated. Consumers in many countries are feeling pressure from higher living costs. Yet bond yields have also climbed, giving investors an alternative place to park money for short-term returns. In uncertain environments, large institutions often move toward liquidity first, safety second, and long-term positioning third. That behavior sometimes creates temporary market contradictions that confuse ordinary investors. But history shows something interesting. During major periods of financial stress, gold has often experienced short-term weakness before stronger moves later. Sometimes, institutions sell valuable assets temporarily to cover losses elsewhere. Sometimes, fear creates unusual market behavior before fundamentals return. And sometimes, markets begin signaling deeper problems long before the public fully understands what is happening. The real question may not be why gold is falling today. The real question may be what large institutions believe is coming next. There's a pattern that often appears before financial pressure spreads across an economy. It rarely begins where most people are looking. It does not start with stock market headlines or social media panic. Instead, it usually begins quietly in places most ordinary investors ignore. An oil shipment delayed, a shipping route interrupted, insurance costs rising in conflict zones, energy becoming slightly more expensive week after week. At first, these changes seem small, temporary, easy to dismiss. But history shows that when energy prices begin moving sharply during geopolitical tension, the consequences rarely stay contained for long. This is where the story surrounding gold becomes much more complicated than many people realize. Gold is not simply reacting to fear. It is reacting to the economic chain reaction created by fear. And right now, that chain reaction appears to be accelerating. When global tensions rise, oil often becomes the first warning signal. Markets begin pricing in disruption before shortages even happen. A military escalation near an important shipping route, political instability in a major oil-producing region, sanctions, retaliation, or trade restrictions. Each event slowly adds pressure to energy markets. Businesses feel this pressure first. Transportation becomes more expensive. Manufacturing costs rise. Food producers face higher fuel and fertilizer expenses. Shipping companies raise prices. Eventually, ordinary consumers begin paying more for nearly everything. This is how inflation quietly returns, even when governments claim it is under control. For business owners and entrepreneurs, this stage becomes especially dangerous because higher costs begin attacking both sides of the equation. Companies face rising expenses while consumers slowly lose purchasing power. Families cut spending, small businesses see demand weaken, profit margins become harder to protect. Expansion plans suddenly feel risky, and uncertainty spreads faster than confidence. Normally, many investors expect central banks to step in during economic weakness by lowering interest rates. That expectation often creates confidence in markets. But what happens when inflation remains too high for policymakers to act? That is where the pressure on gold begins to make more sense. When inflation stays elevated, central banks become trapped. Cutting rates too early risks making inflation worse. Keeping rates high slows economic growth. It becomes a balancing act with consequences on both sides. Investors begin paying close attention to government bond yields because higher yields suddenly become attractive. A Treasury bond offering strong returns may temporarily look safer than holding an asset like gold that pays no yield. This is often the moment when financial media creates a simple narrative. Gold is falling because higher yields make it less attractive. But serious observers understand that explanation only tells part of the story. Because rising yields themselves are not necessarily signs of economic strength. Sometimes they reflect fear. Fear that inflation is becoming harder to control. Fear that governments may need to borrow more money. Fear that deeper financial pressure is quietly building beneath the surface. And history reveals something uncomfortable. Prolonged inflation mixed with geopolitical instability has rarely been a peaceful combination for economies. Markets can ignore pressure for a while, until suddenly they cannot, which raises an uncomfortable question serious decision makers may need to consider. If inflation remains stubborn, oil keeps climbing, and global tensions continue spreading, what exactly are financial markets preparing for next? There is an old pattern in financial history that ordinary investors often discover too late. By the time fear becomes visible on television, the largest institutions have usually already made their move. They rarely wait for certainty. They rarely follow headlines. And they almost never explain their positioning while events are still unfolding. Instead, they quietly prepare while public attention remains focused somewhere else. That may be exactly what makes this moment so difficult to understand. Because while many retail investors are staring at gold's falling price and assuming weakness, some of the world's most powerful financial players may be asking an entirely different question. Not why is gold falling, but what stress is building underneath the system? History offers a warning here. During periods of global instability, institutional behavior often looks confusing at first. In moments of uncertainty, large hedge funds, pension managers, sovereign wealth funds, and central banks rarely move emotionally. Their first concern is survival. Their second concern is liquidity. Their third concern is opportunity. This order matters because it often creates market movements that appear irrational to the public. When volatility rises, institutions frequently sell strong assets first, not weak ones. That sounds backward, but there is a reason behind it. Assets with deep liquidity can be sold quickly to raise cash. Gold often becomes one of those assets, not because institutions suddenly stop believing in gold, but because they need capital to cover losses elsewhere, rebalance portfolios, reduce leverage, or strengthen defensive positions. To ordinary investors, this can feel like panic, but institutional behavior and panic are not always the same thing. Sometimes what looks like fear is simply repositioning, and this is where the gold sell-off becomes more interesting. Because beneath public market noise, central banks across several nations have spent years increasing exposure to physical assets and reserve diversification. Many governments have quietly shown concern about currency instability, sovereign debt risks, and geopolitical fragmentation. Public speeches may sound calm, but reserve strategies often reveal what policymakers truly fear. At the same time, large institutions closely monitor signals most people never notice: bond market stress, currency volatility, commodity disruptions, credit conditions, debt refinancing pressure. These signals matter because financial systems rarely break suddenly. Pressure usually builds quietly first. Hidden inside areas most people ignore until the consequences become impossible to avoid. For entrepreneurs and business owners, this matters more than many realize. Because understanding how major institutions behave during uncertainty can change how risk is managed. Those who misunderstand transitions often react emotionally. They chase headlines. They mistake short-term volatility for long-term truth. They sell during confusion and return only after prices recover. But those who study capital flows understand something different. Temporary price weakness does not always mean weakness in the underlying thesis. Sometimes it signals preparation, which leads to a deeper and far more uncomfortable possibility. What if this gold correction is not a sign that fear is disappearing, but evidence that larger financial players are quietly positioning for something the public still does not fully see? The most dangerous moments in financial history are rarely the loudest ones. They often arrive quietly, disguised as temporary corrections, short-term panic, or market noise that most people assume will quickly disappear. By the time the real consequences become obvious, positioning has already changed, capital has already moved, and ordinary investors are left reacting to events rather than preparing for them. That is what makes this gold sell-off worth watching so carefully, because the biggest question may no longer be whether gold can recover. The bigger question may be whether the forces pushing gold lower today are actually creating the conditions for something much larger tomorrow. At the center of this story sits a difficult reality. The global economy appears to be entering a period where several risks are rising at the same time. Geopolitical tensions remain elevated. Energy markets continue facing uncertainty. Government debt levels across major economies remain historically high. Inflation has slowed in some places, but not disappeared. And central banks continue facing an uncomfortable balancing act between controlling inflation and protecting economic growth. Normally, policymakers respond to slowing economies by cutting interest rates. But if inflation remains stubborn while global instability keeps pressure on energy prices, their choices become limited. Lower rates too early, inflation risks returning more aggressively. Keep rates elevated for too long, and economic pressure begins spreading through businesses, consumers, and debt markets. This is where serious decision makers begin paying closer attention. Because economies built on debt become highly sensitive to interest rates. Businesses refinancing loans face higher borrowing costs. Governments must spend more to service debt. Consumers reduce spending as living expenses rise. Slowly, financial pressure begins moving through the system, often quietly at first. And markets rarely move in straight lines during these periods. Gold could experience further weakness. More volatility may still come. Institutional repositioning may continue. Fear could push investors toward liquidity before confidence returns. None of those outcomes would be unusual during periods of transition. But history also offers an important lesson. Long periods of geopolitical instability, persistent inflation, and financial uncertainty have often changed investor behavior over time. Assets ignored during moments of confusion sometimes become attractive again when deeper risks finally emerge into public view. For entrepreneurs, investors, and business owners watching these developments, the challenge may not be predicting every market move correctly. The challenge may be understanding the larger trend forming beneath short-term headlines, because temporary price action can distract from structural change. And sometimes, the market tells its real story in reverse. The strongest assets fall first. Confidence weakens before fear becomes visible. And by the time the public fully understands the scale of economic change, the opportunity to prepare has already passed. So perhaps the real question is no longer whether this gold sell-off ends next week or next month. The real question is this: if global tensions continue rising, inflation remains difficult to control, and financial pressure quietly builds beneath the surface, was this decline the end of gold's story, or merely the beginning of a much larger economic shift?